Welcome back to Synaptic Dividends. So today we're taking a look at Linde, the world's biggest industrial gas company. And we're asking a pretty simple question. Is their dividend a rock-solid industrial strength source of income, or is it all just hot air? Let's jump into the numbers and find out. All right, so for any of us looking for income, the very first thing we have to ask is the dividend safe? I mean, can the company actually afford to pay you? To figure that out, we have to look at what is, in my opinion, the single most important safety metric there is.
And that metric is the free cash flow payout ratio. Now, I know it sounds a little technical, but it's really simple, I promise. Think about your own paycheck. After you pay all your bills, your rent, groceries, everything, and you set some money aside to invest, this ratio is the percentage of the leftover cash that you use. It's the most honest way to see if a dividend is affordable. So what's Linde's number?
It's 54.8%. Now, for some context, anything under 60% is what we consider the green zone, a really healthy level. So Linde is comfortably safe. This means they're using just a little over half of their real cash profits to pay shareholders. That leaves a massive cushion to reinvest in the business, make acquisitions, or just handle any surprises the economy throws at them. The bottom line? The dividend is definitely secure. Okay, so a safe dividend is step one. That's a huge check mark. But, a dividend that just stays flat gets eaten alive by inflation over time. We want our income stream to get bigger every year. So that brings us to our second pillar. Is it growing? Get ready for this one. 33. For 33 consecutive years, Linde has given its shareholders a raise every single year. A track record like that isn't just a company policy. It shows you that returning cash to shareholders is baked right into the company's DNA. It's just what they do. And we're not talking about tiny symbolic increases here either. Just look at how consistent this growth is. Over the last 1, 3, and 5 years, that dividend has been growing at a clip of 9 to almost 10% per year. Even if you zoom out over an entire decade, it's still nearly 8%. That is the absolute sweet spot for dividend growth. It's strong, it's reliable, and it's predictable. All right, so let's recap. The dividend is safe. Check. It's growing consistently. Double check. But now it's time for the ultimate test. How does this dividend hold up when things in the world get, chaotic? Pillar number 3, is it battle-tested? This right here is what truly separates the great companies from the good ones. During the 2020 pandemic, when countless other businesses were cutting their dividends, Linde raised theirs by over 10%. And if you think that's impressive, go back to the great financial crisis of 2008. They hiked their dividend by an incredible 25%. This company doesn't just survive crises, it actually thrives through them. That's real resilience. So, we've looked at the safety, the growth, and we've put it through the ultimate stress test. What's the final verdict on Linde's dividend? I mean, the numbers are pretty crystal clear. We have a conservative payout ratio, which means the dividend is easily affordable. We have that amazing 33-year growth streak showing a deep commitment to shareholders. And it's proven it can grow right through 2 of the worst recessions in modern history. Based on all the numbers, Linde's dividend is the very definition of industrial strength. Now, this was just a quick look at the key numbers, but if you want to go deeper and understand the full business model, the competitive advantages, and the management behind these results, check out our long-form podcast analyses on our channel, Synaptic Investing.